You're sitting at your desk, coffee going cold, staring at your portfolio app, and the number on the screen is down. Not a little, a lot. And your finger is hovering over the sell button. You keep refreshing, down again. And somewhere in the back of your mind, you're thinking, did I miss something? Was there a sign? Because right now it feels like the entire financial world just flipped upside down overnight and nobody told you it was coming. Here's the thing. Somebody did see it coming. Several somebodies, actually. And the pattern they used to see it, it's been hiding in plain sight for over 100 years. My name is Smith, and I spend way too much time thinking about geopolitical risk and what it does to your money. If you're someone who feels like global events are completely unpredictable and there's no way to protect your portfolio from the chaos that happens when the world decides to lose its mind, hit subscribe and give this video a thumbs up. Because what I'm about to walk you through today is going to fundamentally change how you look at market crashes, war, and the terrifying, beautiful, completely learnable pattern that connects all of them. Let's get into it. Now look, when most people hear the phrase Black Swan, they immediately think of the 2008 financial crisis. Nassim Taleb wrote the book, the term went mainstream, and suddenly every market pundit on television was calling everything a black swan. The pandemic, Black Swan. The 2020 crash, Black Swan. The crypto blowing up, Black Swan. The word has been so overused that it's lost almost all of its meaning. But here's what most people don't realize. Taleb's actual definition of a black swan is extraordinarily specific. It's not just a big, bad, unexpected event. A true black swan is an event that has three properties. One, it's an outlier, completely outside the realm of regular expectations. Two, it carries an extreme impact. Three, after it happens, human nature makes us construct explanations that make it seem predictable in retrospect. That last part is the killer, because when we convince ourselves that the last crisis was predictable in hindsight, we stop preparing for the next one. And this is where it gets interesting, because war crashes, the specific, devastating market collapses that happen during geopolitical conflict, are not actually black swans in the true sense. They just feel like them. The data going back to the Franco-Prussian War of 1870 through both world wars, Korea, Vietnam, the Gulf War, 9/11, the Russian invasion of Ukraine in 2022, every single one of these events followed a recognizable sequence, a fingerprint. And that fingerprint is showing up again right now in 2026. Let me explain what I mean. Think about what a market actually is. At its core, a market is just a collection of human beings making bets about the future. That's it. When you buy a share of a company, you're not buying a piece of that company in any real physical sense. You're betting that other human beings in the future will be willing to pay more for that piece of paper than you paid today. The market is fundamentally a sentiment machine. Now here's the psychological insight that almost nobody talks about. Human beings are extraordinarily bad at pricing in low-probability, high-impact events. There's a whole field of behavioral economics built around this. Kahneman and Tversky called it the availability heuristic. We judge the probability of something based on how easily we can imagine it. When markets are calm, when the news cycle is quiet, when things feel stable, the idea of a major war becomes, psychologically, almost unimaginable. Not because people are stupid, because they're human. And this creates a very specific, very measurable pattern. In the 18 months leading up to every major conflict-related market crash since 1900, researchers at the Bank of International Settlements found something remarkable. Volatility, the VIX or its historical equivalents, tends to be abnormally low, unusually, almost suspiciously low. Markets are calm, investor sentiment is tilted optimistic, and credit spreads, the difference in yield between safe government bonds and riskier corporate debt, are narrow. The world, financially speaking, looks fine, right up until it doesn't. Let me give you a specific example because I don't want this to stay abstract. The summer of 1914. Markets across Europe are performing reasonably well. The assassination of Archduke Franz Ferdinand happens on June 28th, and for almost 3 weeks the global financial markets barely react. The London Stock Exchange, the most important financial market in the world at that time, actually stays open. Investors broadly do not sell. Why? because they cannot imagine that this regional political assassination is about to cascade into a war that will kill 20 million people and restructure the entire global economy. Then on July 23rd, Austria-Hungary issues its ultimatum to Serbia. And in the span of 6 trading days, 6 days, the Vienna Stock Exchange collapses completely. The St. Petersburg Stock Exchange shuts down. The London Stock Exchange closes for the first time since its founding in 1801. It stays closed for 5 months. By the time it reopens, British investors have lost, in today's money, the equivalent of roughly $2 trillion in market value. $2 trillion in 5 months, after 3 weeks of almost no reaction at all. Now you might be thinking, okay, that was 100 years ago. We have better information now, faster communication, more sophisticated risk models. Surely we've learned to price in this stuff earlier. Here's the thing, we really haven't. Fast forward to August 1990. Saddam Hussein invades Kuwait. The S&P 500 drops 19.9% over the following 3 months. In the weeks before the invasion, despite significant military buildup that was visible to satellite intelligence that wasn't exactly secret, the market had priced in almost zero probability of a full-scale military offensive. The VIX, which had been tracking near historical lows, exploded. Oil, which is the lifeblood of the global economy, nearly doubled in price in a matter of weeks. A portfolio of $100,000 that was sitting fully invested in an S&P 500 index fund on August 1st, 1990 would have been worth approximately $80,000 by October 11th. A $20,000 loss in 71 days. And the psychological research on loss aversion, Kahneman again, tells us that losing $20,000 feels approximately twice as painful as gaining $20,000 feels good. So emotionally, that drop felt like losing $40,000. That's the real cost, not just the money, the psychological cost. And then, here's the pattern repeating, once the Gulf War started going well for the coalition, once it became clear this wasn't going to be a prolonged quagmire, markets recovered sharply. Investors who panicked and sold at the bottom locked in a $20,000 loss. Investors who held, or better yet, bought during the chaos, recovered fully within 7 months and went on to participate in one of the greatest bull markets in modern history. This is where the pattern gets almost poetic. Every major geopolitical crash has 3 phases. I want you to memorize these because they are happening right now, and being able to identify which phase you're in is genuinely valuable. Phase 1 is the slow boil. This is the period, usually 6 to 18 months, where the underlying tensions that will cause the conflict are building. During this phase, the market is largely ignoring the signals. There might be some volatility, some nervous op-eds in the Financial Times, but broadly, money is still flowing. Valuations are still elevated. The sentiment machine is still saying probably fine. Phase 2 is the shock event. This is the moment of escalation. The invasion, the attack, the speech that breaks a negotiation. The market in this phase behaves in a very specific way. It drops fast, hard, and with almost no rational discrimination. In a panic, investors sell everything. Good stocks, bad stocks, gold, real estate investment trusts, everything gets hit. This is the phase where amateur investors make decisions they regret for years. Phase 3 is the resolution drift. This phase begins when the market believes, whether correctly or not, that the worst-case scenario is off the table. The conflict either ends, stabilizes, or gets priced in as the new normal. In this phase, the market tends to recover often rapidly and often to levels above where it started. The pattern, slow boil, shock event, resolution drift, has repeated with remarkable consistency across every major conflict-related crash for over 100 years. And here's what makes 2026 genuinely unsettling. We are, right now, in what looks unmistakably like a slow boil. Now, look, I'm not a geopolitical analyst, and I'm not going to stand here and tell you that World War III is starting in 6 months. I don't know that. Nobody knows that. But what I can do is read the financial fingerprint, and the fingerprint is concerning. Global defense spending as a percentage of GDP is at its highest level since the Cold War ended in 1991. According to SIPRI, the Stockholm Central International Peace Research Institute, total global military expenditure crossed $2.4 trillion in 2024 and has accelerated since. That's not a commentary on whether the spending is justified. That's simply a signal. When governments start spending money at that scale on weapons, the market is watching. Credit spreads, remember those are the warning signal that the BIS flagged in every pre-war period, have been widening. Not dramatically, not in a way that makes headlines, but measurably. The spread between U.S. 10-year Treasury yields and investment-grade corporate bonds has been drifting up since mid-2025, even as equity markets have remained relatively stable. That divergence is a signal. The bond market, which is considerably smarter and less emotional than the equity market, is starting to get nervous. And commodity markets, particularly oil, natural gas, and rare earth metals, are showing supply concentration risk that hasn't existed at this level since the 1970s oil shock. Here's what most people don't realize about the 1970s oil shock. The psychological damage it did to investor behavior lasted for over a decade. The S&P 500's real inflation-adjusted return from 1966 to 1982 was essentially zero. 16 years, an entire generation of investors who contributed to their retirement accounts faithfully every single month and ended up approximately where they started in real terms. If you started investing in 1966 at age 35, you were 51 years old before the market started working for you again. That is the real cost of not understanding geopolitical risk. Now, here's where I want to give you something actually useful, because I'm not interested in making you scared. Fear is not a financial strategy. And I've watched too many people consume this kind of content and then make exactly the wrong decision. Panic selling quality assets, moving everything into cash, sitting on the sidelines while inflation quietly erodes their purchasing power. So let's talk about what the historical record actually says you should do during a slow boil. The first thing is what I call stress testing your allocation. This is not complicated, but almost nobody does it honestly. Get your portfolio up on screen right now or after this video and ask yourself one question. If the worst-case geopolitical scenario unfolds over the next 12 months and markets drop 35%, which is roughly the average peak-to-trough decline in a major conflict-driven crash, what happens to your financial life? Not your portfolio, your financial life. Can you still pay your mortgage? Can you still fund your emergency account? Do you have a job that's relatively stable, or is it tightly correlated to market performance? If a 35% drop genuinely threatens your financial stability, your portfolio is probably too aggressive for your actual risk tolerance, regardless of what you told the questionnaire when you opened your brokerage account. The second thing is understanding the geography of risk. Not all assets are equally exposed to geopolitical disruption. Energy companies, particularly those with diversified supply chains, have historically outperformed during conflict periods because of the oil price dynamics I mentioned earlier. Defense stocks obviously get a tailwind, but here's the less obvious one. Domestic-focused small-cap companies, the businesses that generate most of their revenue inside their home country's borders, tend to be dramatically less affected by international conflict than multinational corporations with complex global supply chains. During the 2022 Russian invasion of Ukraine, the Russell 2000, which is the index of small U.S. companies, outperformed the S&P 500 significantly in the weeks following the invasion precisely because of this supply chain exposure differential. The third thing, and this is the one that feels counterintuitive but is supported by a century of data, is the case for holding some gold. Not a lot. I'm not saying become a gold bug. I'm talking about a 5 to 10% allocation. The research from Trinity College Dublin, analyzing gold's performance across 14 significant geopolitical crises from 1973 to 2020, found that gold provided positive real returns in 11 out of 14 cases. It's not a magic hedge. It doesn't always work perfectly, but it's the one asset class that has a credible historical track record of preserving purchasing power during the specific type of chaos that geopolitical conflict creates. Now you might be thinking, but Smith, if this pattern is so well known, hasn't the market already priced it in? Isn't everyone looking at the same data? This is actually a great question, and the answer is both yes and no. Here's the thing about market pricing. Yes, sophisticated institutional investors know about geopolitical risk. They have entire departments dedicated to it. But here's the problem they face. If you're a fund manager running $50 billion, you cannot just call your clients and say, I think there's a 20% chance of a significant conflict in the next 18 months, so I've moved a third of the portfolio to cash. Your clients will fire you. They're paying you to be invested. They're paying you to outperform the benchmark. The career risk of being early is career ending. So even when smart, well-resourced investors see the signals, the structural incentives of the industry prevent them from acting on them. This is what the economist Hyman Minsky was really getting at with his famous insight, the thing that's now called the Minsky moment. Stability breeds instability. The longer a system appears stable, the more aggressively people exploit that stability, and the more fragile the system actually becomes. The slow boil isn't just a geopolitical phenomenon, it's a financial phenomenon. It's money flooding into assets because the world looks calm, which makes those assets more overvalued, which makes the eventual correction more severe. It's a doom loop, and it's been running for a long time. Let me leave you at this. In 1939, just weeks before Germany invaded Poland and the Second World War began in earnest, the Dow Jones Industrial Average was trading near its recovery highs. The U.S. economy was improving. Investors who had survived the horrors of the Depression were finally cautiously beginning to believe that the worst was over. And then the world changed. The Dow dropped 40% over the following 3 years. Unemployment spiked. An entire generation's financial assumptions were shattered overnight. But here's the ending of that story that most people forget. The investors who did not panic. The investors who held their positions through the darkness, who continued contributing to their accounts, who understood, even without the benefit of historical data we have today, that economic activity does not permanently stop, that companies continue to innovate and earn profits, that human beings continue to want products and services even during conflict. Those investors participated in what happened next. By 1950, the Dow had doubled from its 1939 levels. By 1960, it had tripled. By 1970, it had quadrupled. The investors who made decisions based on fear in 1939 missed one of the most extraordinary wealth-building periods in the history of the modern economy. The pattern that predicted every major war crash is real. The signals are worth watching. The preparation is worth doing. But the single most expensive mistake you can make in 2026 is letting the preparation become paralysis. Because here's the final thing I want you to hold on to. Every war ends. Every conflict resolves. Every market crash in the entire recorded history of financial markets has eventually been followed by a recovery. Not always quickly, not always neatly, but always. The question isn't whether the world will make it through whatever comes next. It will. The question is whether your portfolio and your psychology are positioned to be on the right side of that when it does. Protect the downside, stay invested, keep learning. I'll see you in the next one.